Now, we have seen in UAE has so many free zones, and every Emirates has so many free zones apart from it. So, but one of the final point which we always look at is most of the free zone in UAE, if not all, do not permit a company registered with such free zone to do business outside the free zone in the mainland, unless company obtains appropriate license from the local authority. So if you're talking about Dubai, we are talking about Dubai Economic Department. We are talking about Sharjah, we are talking about Sharjah Economic Department, which is uh, authority. May I request people who are not on, you're not speaking or don't want to say something, then can put on themselves on mute. Let me check, or maybe put up. Okay. There is someone waiting. Just give me 1 minute. I think someone is. Okay. So just coming back to the discussion point. So most of the free zone in UAE, as we just talked about, if not all, do not permit a company registered with such free zone to do business outside the free zone in the mainland, unless these companies are obtain an appropriate license or approval from the local authority. So this is a stand which is there for all the free zones. So if you talk about safe zone, Rakis, Abu Dhabi, Global Market, Javza, DIFC, DWTC, DWC, whichever free zone we talk about, look at their articles and memorandum or their legislation, which does not allow technically to operate in the mainland activity. So they are either authorized to do business within the free zone or outside the UAE. So that is where it comes into. So now from obligation for a free zone company, the business established in free zone will be required to register and file a corporate tax return to claim the benefit of no or lower tax application. So generally we are from a UAE perspective, it will be a no tax application. So if there are businesses which are done within the preview of a free zone, that means you're not doing business with mainland, you're not doing business outside the free zone, and you're not doing business anywhere within the UAE framework outside the free zone, then there will be an obligation under a specific section which allows us to claim that income as a non-taxable income. So that is what the framework will come. Will the free zone be completely out of the preview of VAT? Preview of corporate tax? Answer is no. They definitely will be required to register under the corporate tax, pay and even assess themselves as a corporate tax assessee and claim the benefit of a free zone. So that is where it comes into. We are still waiting for further details and compliance, which will come on a tax regime perspective. But a lot of people who are thinking that free zone will be out of the tax preview, answer is no. Assessments are going to be part of a corporate tax for the free zone. There will be allowable deductions or allowable expenses and incomes which are not going to be assessed from a corporate tax perspective. So that is where the benefit will come to the free zone. They're definitely going to be beneficial than any other. There will not be a different treatment for different free zones. So free zone will have one kind of a section. Generally, these are sections which define income which is not taxable being earned in UAE under the special provisions. So the UAE corporate tax treatment will apply to businesses in free zone, will be same across all free zones. So there will not be any, you can say, ambiguity or a differential between what kind of a different treatment being provided to different free zones. So that is where it is. Now comes some of the salient features and implementation of corporate tax. So these are some of the points which were asked in the chat also. Will the set-off be allowed? Yes, set-off will be allowed. UAE corporate tax regime will allow set-off of profit and losses. So if there is a loss after the corporate tax came into implementation, which can be set off in the future profit, so that will be definitely allowed. UAE corporate tax regime will allow business to use losses incurred as from the UAE corporate tax effective date to offset taxable income in subsequent financial period. The loss of corporate tax purposes, that is tax loss, would arise when a total deductions of the business can claim are greater than the total income of relevant financial period. So this will again, as we talked about before also, your income and expenses which are allowable and which are not allowable need to be adjusted before we arrive at the profit or loss for any organization. So set off definitely is part of the Q&A framework which Ministry has released and will be allowed from a corporate tax perspective. So loss of a year one can be set off with a profit of year two. Now there is something interesting which we have seen, which is generally not there in other jurisdictions, which is UAE group of companies can elect to form a tax group and can be treated as single taxable person, provided certain conditions are met. So this is where we talked about any transaction between these groups may not attract any kind of a taxation, may not have any taxability, which comes into there. So those framework are going to be there, but we need to be very careful when we adopt that group structure, because once a family, always a family kind of a thing will happen unless you again go back and call for degrouping. So UAE tax group will only be required to file a single tax return for the entire period. Now there can be some catch because taxation is going to be slab based. If a taxation is going to be slab based, you may lose a slab for which there is a zero taxation. So it has a lot of points to be looked at, and we have put up some checklist also after this pointers which I want to cover. But definitely you can form a tax group. There are instances we have seen where people have multiple companies, not for any one reason, maybe just for the visa purpose only, because you can't take more than X number of employees in one company, so you have established multiple companies. Those kind of structures make very important part to call it as a single tax group, because the company which has only visa will always be an expense line, and the other company will be earning. So it's good case study to make sure this form part of a tax group, so that you can set up the expenses and income within the group and pay taxes only on the net value. So there is a provision, and that will be released as a part of a legislation which comes into. Withholding tax, a lot of deliberation was there on the whether there will be a withholding tax. So the questionnaire has very clearly said no withholding tax will be there. So it may not be applicable on domestic and cross-border payment of any nature under the UAE corporate tax regime. So that is where you will not have a provision of where the taxes are withheld. Yes, if a permanent establishment is established, then a tax assessment has to be done and taxes need to be paid also may come into. Wherever we have seen the foreign companies having establishment within UAE, in those cases, it's not only about withholding, maybe you're required to comply to the whole framework of corporate tax itself, rather than calling it as a part of a withholding tax structure. Now, there's something interesting on the tax credit, so which is technically a global phenomenon where foreign corporate tax paid on UAE taxable income will be allowed as a tax credit against the UAE corporate tax liability. So in this case, what happens is wherever the foreign tax credit are offset income paid in the taxes in the offsite location or in the foreign country. So UAE tax resident who pays income tax imposed by a foreign country can claim the credit. Example, there is some income where the tax is being charged in let's say Singapore or Hong Kong. You can claim a benefit of that by paying the lower taxes in UAE on that income. So one is it is majorly to see that you are not being double taxed. So these are part of the treaties. These are part of the regulations which are done. So if income is earned in X location and you receive the dividend here, dividend is not anyway going to be taxable. So that's how the tax credit benefit comes into, especially from a US perspective where global incomes are taxable. It is a very good tool where if you pay taxes in any outside jurisdiction, you can adjust those taxes paid on account of taxes which is due from a US perspective. So similar thing, we can vouch for that, which will be applicable in the UAE regime also. Now something very interesting on the transfer pricing side. This we have seen from a ESR also in a limited way. So transfer pricing will be applicable. Now, how this has to be looked at from my accounting perspective, from a advisory perspective also. Let's understand broadly the transfer pricing. This is where the transfer cost is the price at which related parties. So the important part is there should be a related party which are there in that. If it's a third party or independent parties, then transfer pricing does not attract. So transact with each other, such as during the trade of supplies or labor between departments or organization. Transfer pricing may be used in a transaction between a company and its subsidiaries or between divisions of same company in different countries. So wherever there is a transaction happening between related parties, so how the transfer pricing is applicable, how the transactions are being conducted is going to be very important. Now, there are 3 bullet points which comes as part and parcel from a transfer pricing perspective. One is transfer price that differs from market value will be advantageous for one entity while lowering the profits of the other entity. So let's take example as we've seen on economic substance regulation also. If you are charging more or less, there is a benefit or there is a BEPS, which is a base erosion profit shifting, may tantamount to, and that is where it this section tries to cover up the activity. So in this case, if you see the market value will be advantageous for one entity while lowering the profits of other entity. So that is what it comes into. Example, if you are shifting the profits, that means what you are doing is you are making more, you are generating more revenue or more profit within the UAE framework. Then it becomes a tough thing to look at from a activity perspective. Multinational companies can manipulate transfer price in order to shift profit to the low tax region or regime. So that is where it becomes more important. And this was part of the BEPS framework 8 to 10 is what we looked at the action plan. To remedy this, regulations enforce an arm's length transaction rule that requires pricing to be based on similar transactions done between unrelated party. So I'm sure a lot of auditors and wherever the financial books are being prepared, there is a lot of action plans or there is a lot of pointers which are looked at from a transfer pricing perspective, and this is part of current audit also. Just give me a minute. There is some question which is coming up, so let me pick it up. What if withholding tax be applicable as well for tax paid in Qatar, for instance? So withholding tax, what is paid in Qatar, if it is part of the UAE income, yes, you will get a benefit out of that. But we need to look at whether the income is a UAE income or a Qatar income. So that is where the difference comes there. Stephen is asking, shall we expect a transfer pricing on, shall we expect to start reporting on transfer pricing in UAE soon? Answer is yes. To an extent, we are also reporting right now as part of ESR. So when you buy from a related party or you provide a services to the related party, you are defining right now the profitability. The section or transfer pricing regime is not applicable right now, but reporting has already started on the ESR's basis, which you see. Do you, Ozar is saying, do you foresee any compliance requirement, documentation requirement for TP along with CIT similar to Qatar? Definitely. So the moment transfer pricing comes into, you need to definitely look at more documentation and compliance because it's not going to be a statement, it's going to be a proof also that the profits are generated in the right order. And just to take you back, so this is part of the BEPS framework. So 8 to 10 action plan is quite mandated, and it's quite stringent from a BEPS framework also. So that's the reason I picked up the BEPS framework, so we can understand why these sections are coming and why these logics or these kind of a framework are getting deployed into. Definitely, the documentation on transfer pricing is going to be much more detailed. And right now, UAE does not have anything on the transfer pricing except for some of the companies who do on willingly basis, but there is no enforceable actions which are there on a transfer pricing. UAE business will need to comply with transfer pricing rules and documentation requirements set with reference to OECD transfer pricing guidelines. So that is what where it also comes into. So OECD also already has a transfer pricing guidelines, which Qatar technically operates into quite a big way. Yes, these frameworks are going to be quite an add-on work from audit perspective also, wherever auditors are working in. Administration, new website from FTA which has come up has already started reflecting a good action plan where they are defining how to register the corporate tax which is coming soon, or filing returns and payments which is coming soon. So administrative authorities is Federal Tax Authority. There are questions on whether there will be fines and penalties. Definitely, whenever there is a law, there is a fines and penalties comes into play. There are the administrative part is completely taken by Federal Tax Authority. Now, Federal Tax Authorities, the biggest part I will say is there are a lot of things getting connected now. So you are submitting your VAT return, your excise return with Federal Tax Authority. You are submitting your economic substance regulation document, which is administrative done by from the tax authority perspective. Income tax, which is corporate income tax, is going to be with the Federal Tax Authority. So you can imagine what kind of a data participation these organizations have now, these regulatory bodies have now. Even for tax residency certificate, documentation is getting assessed or evaluated by Federal Tax Authority only. So having a centralization of each section will have a lot of, you can say, close connect to how the data is being assessed, how the data is being looked at. And this is going to be a foremost important thing from a regulatory framework perspective. We cannot have different statements in the different legislations. So as you know, there are some cases where still custom duties are differently being declared, and in VAT documentation are very differently declared. I think it's only a matter of time before these things were caught by the regulator, and their regulators are asking questions also on these places. Now we have looked at what kind of a tax framework, tax activities are there, but there are a lot of actions which can be taken and on implementation of corporate tax. What we do so far, we don't know the legislation. Is it something which we take an action right now, or we can wait for an action? Those things becomes part and parcel of a corporate tax framework. First is I started talking to the clients from our side also. We are just very simple asking them is, do we have an ability to generate financial statements at a business license level? So a lot of time we have seen the grouping is being done, or consolidated financials are done at a group level. So do we have an ability to generate financials at a business license level is very important. As I talked about, there are organizations which have closely connected entities, which is fine, but can we have financials? Because that's going to be an important integral part of activity. So very clear demarcation between expenses booked in the company where this is related to, or income booked in the company which is related to, because this is not a VAT framework, this is an income tax framework, and income tax framework looks at each entity at an independent level. Mohammed is asking, profit generated from a sale of property to related party taxable or not taxable? Mohammed, will go back to the corporate tax framework itself, where the real estate is being set aside as a part of a taxation framework. So if it is already set aside as a part of a taxation framework, then related party transaction does not come as a question. But still, as we talked, it should be a non-licensable activity and should be generated at an individual level. So far, no taxation. And once that there is no taxation, you will not assess for a related party, because there is no impact happening if you generate more profit or less. So going back to the actions which we are talking about are financial. So if you are with whatever financial system or accounting system you are using, it's more important now. It was in fact important at the VAT era also, that right books and right accounts are being used into. We are still seeing some of the companies which are not tax group, and when the transactions are happening between the so-called ownership grouping, VAT implications are not being used, so that may not be aligned in a longer run. You may face penalties and fines on that part. So similar things are becoming an action plan from here also, that where we have a right financials at a license level, not at a group level, which are being maintained there. Next comes impact assessment, that is review of business model and accounting policy. So the law or the framework is attracting towards international accounting practices or accepted international accounting policies. So we need to look at predominantly from an IFRS perspective, are our books and accounts and our policies are aligned or not. Generally, we are not seeing accounting policies being maintained by a good number of organizations, except for the people who are getting it audited, and that too becomes a part of audit report itself, where you define what kind of a depreciation being taken, what kind of accrual methods are being used, what kind of unbilled revenues are being charged, and all that part. So from a accounting policy perspective, we need to make sure that our accounting policies are starting drawing up. We have a right documentation which is being assessed, maybe taking help of accounting team or auditing team to see that these are aligned with the IFRS, and how we can structure this in a way that we can ring fence any kind of abnormalities which comes into the framework. Now something quite interesting to be looked at. UAE, a lot of companies are multi-holding companies, where you have a free zone company, you have a mainland company. In a lot of cases, we have seen wherever the capex comes into, generally these are held by the free zone company, where the capex means capital expenditures, because expats want to ring fence the capital which is being deployed, and the operating companies or OPEX generally comes into the mainland company. So the structures need to be revisited from a corporate tax perspective. Do we have, again, as we talked about, a separate accounting, separate regulatory framework for each company? So organization structure review becomes an important part, primarily for entities having business license in mainland, free zone, and multi-country presence. First is, we need to look at, we are not 750 million euro above entity. If it is, then we are going to the global minimum taxation regime. If we are below that, then we need to look at whether we are a pure corporate structure with the UAE, with the mainland company, or a free zone company. Shailesh is asking a question: corporate profit from a sale of normal goods, not real estate, related parties not registered under one group, will be taxable. See, wherever the related party comes into, taxable, definitely it is because it's a sale and purchase of goods, and it's a normal course of business, is what I understand. The moment related party comes in, you need to look at a transfer pricing, whether the profit is being shifted or not, whether it's a normal business model or it's a abnormal business model. So that is where the structure comes into play. So coming back to actions to be taken, is what we are referring here is organization structure review, primarily for entities having business licenses in mainland, free zone, and multi-country presence. You need to look at the free zone structure, how it is, and whether it become a taxable because you are dealing with a mainland company or not. And if it is, then can we ring fence it? So that becomes an important part. I'm not saying that we can take a decision right now. We can start articulating, can start preparing a model document, and so that we understand what kind of a risk which comes into play as if we don't do it. So that is where the structure analysis is important. Now there is something which is the remuneration or benefits to shareholders and beneficial owners. So our understanding as it talks right now, any remuneration to the shareholders or beneficial owners will not be allowable expense. So there is a discussion which is happening across various segments, and where even our clients have also approached us. Why don't we start showing more director remuneration or shareholder remuneration who are the beneficial owners? Now, the moment you show that kind of a remuneration, these are not going to be allowable in the future. So start assessing, and it has a very direct, indirect impact also, especially for the local entities which are having 51% expat share, 51% local shareholder. What kind of a tax structure it comes into? So it's important to conduct impact assessment and review of remuneration paid to shareholders and beneficial owners. As per prelim assessment, remuneration benefit to shareholder and BOs, beneficial owners, may not be considered as allowable expenses under corporate tax. So there is a one thought which came that we book those expenses, and anyway individuals are not part of a taxation, so will not get it. No, that's not the case. It need to be very clearly assessed. These are not related parties. These are not UBOs. Even related party remuneration also may come as part of a assessment process. So that all need to be looked at, because if you are having a spouse working in the organization and drawing a salary, it's a related party. Assessment documentation will become part of the discussion, and these expenses may be disallowed. I'm not saying will be disallowed, may be disallowed, but definitely the shareholder and beneficial and UBOs remuneration will definitely be disallowed, is our assessment which comes into. Sorry, just to come back on this one more point which I want to say on remuneration is, a lot of time we have a profit share of 80-20, which is 20% goes to the UAE national, which is holding 51% equivalent shares if they have not transferred so far, and 80% comes to an expat. Now, if the remunerations are disallowed, whether it's a tantamount to the profit reassessment or not, again that's a point which we need to look at. If that remuneration is allowable as per the corporate law, then there will be a difference of profits between the corporate law assessment and corporate tax assessment. So that this is a point which need to be assessed once the legal framework comes into play. So this is one of the actions which we are closely watching also, and we'll see how this pans out in the assessment process. Now there are contracts. So existing contracts, if there are there, and the business model also. So where there can be some expenses which are disallowed. So if the expenses are disallowed, the tax becomes a cost to the organization. So we need to start assessing what kind of expenses which may be disallowed as part of the contracts. Now these contracts can be employment contracts, can be a salary contracts, can be an activity contract. So, and even can be a structured contracts between the joint venture entities, where if these are not allowed, then what we are doing is we are bringing up some expenses which will not be allowed, and hence you end up paying corporate tax on equivalent to that expense value which is not allowed. So it's a material thing to look at disallowed expenses, potential disallowed expenses, and revisit the contracts also. So we looked at transfer pricing. We looked at documents which are third-party shipment transactions, where goods are purchased from X location and going to Y location. It's important to understand now the documentation is going to be much more stringent from a corporate tax perspective. A lot of time we have encountered the transactions where the transaction is going from let's say Hong Kong to Africa jurisdiction. When we look at the shipping documents or the BL copies, we don't see anything, any name of a UAE party in that. However, UAE party becomes a buyer from let's say example in this case Hong Kong, and seller to Africa market. From a transaction perspective, fine, we have a purchase, we have a sale. But if I just go to the underlying transaction, those BLs or the shipping documents does not substantiate anywhere that UAE entity is buying goods from that jurisdiction. So these are, I will use the word may impact some kind of assessment. Possible, as we talked in the before also, they will assess that sales is perfect, legitimate, we agree that, but for buying the goods, you don't have a right documentation, so why we allow that? So in one sense, my sales is allowed as a revenue, but my expenses of purchase are disallowed because my documentation not intact. It's going to be a huge impact on tax assessment, and you may end up paying 9% of the sales value, which is going to be not on the profit only. It's going to be the sales value, which can impact. So every documentation, even what we talked before also, what we heard, if there is a transfer pricing, Ozair has asked when the transfer pricing comes into, do we need to maintain the documentation? Yes, that's an important part. Documentation is becoming a critical part in the whole process, in the whole assessment itself. So one is creating documents, and second is making sure that your transaction is completely intact as per the documentation available and as per the claims which you have done. Athena is asking what would be allowable and disallowable expenses. Athena, will need to wait for the full details, but as we talked about, allowable expenses or disallowable expenses will be shareholders remuneration or beneficial owner remuneration. That definitely is a disallowable expenses. Expenses where there is no clear mapping or no clear mention of the party which is paying. Example, I talked about third port shipment. If you're buying the goods and you're selling the goods, when you're buying, your name is not there in the shipping documents. So it may be disallowed as a part of a framework, because your name is the entity or a corporate name is not at all mentioned anywhere as a buyer. So how this entity will look at it. Next comes again, the documentation is going to be critical, as we talked about from a salary perspective also. If you are paying a salary to an employee, and if it's a related party employee, then again you need to look at justify whether the qualification and the remuneration you're paying is aligned or not. Azia is asking a question: is there a maximum period of carry forward of losses? Azia, we don't have an answer right now, but definitely there will be some closure period. Unless returns are filed on time, you will be able to carry forward the losses to the further things. Ozra is asking, will VAT group and CIT group be same as FTA is implementing the CIT online portal? Ozra, I'll not say that it will be same, because having VAT group and CIT, corporate income tax, will be can be a different groups. I'll not say this need to be completely aligned. Yes, FTA will do a different assessment, because if for a VAT you need to create a separate grouping from a submission perspective. For a corporate tax, you need to have a separate grouping from a tax perspective. Janakji is asking, sale commission incentive paid to employee, what kind of a documentation? Yes, that's again an important part. If a sales commission is paid to an employee, is it part of the contract or not? And again, if it is not a related party, it is much more easier to prove. But if it is a related party, then what kind of commissions you are paid? Again, from a contract perspective, make sure if you are paying a sales commission, it is documented. One is it is part of the contractual obligation which comes into play, and second is it has some kind of a genesis on how the business is being obtained. Sales commission to outside party, again it is allowable, subject to that outside party is within the framework of doing that business. A lot of time we have seen where referrals are paid to the person who does not have any kind of a business setup. So those expenses may be disallowed. Just a quick snapshot, like healthcare sector, a lot of time referrals are paid to the doctors which are not supposed to be doing that kind of a business. So now these are generally not allowable expenses. So why our tax authorities will have a genesis, and especially these expenses are paid in cash, because those parties are not eligible to claim that officially. So those are definitely disallowable expenses which comes into play. Joseph is asking, will carry forward losses from a period prior to implementation date may be allowed? No, it will not be. It is very clearly stated that the day from where the corporate tax implementation starts, you can only carry forward losses from there. For startups, are there requirement to register and file CT? Would they not have? They would not have reached 375,000 initially, and would be setup cost be considered allowable? Now, in this case, see, corporate tax, like from a VAT perspective, also there is something called voluntary registration. So you may have, for even claiming the benefit of tax, you will be required to register, or you can say get as a part of a corporate tax registration, and then only you can carry forward the losses. So rightly said, if profit is not there, can we carry forward? You can, but for that purpose, you need to start registering from a tax return perspective, need to file the return on time, and then only set off will be allowable at the future date. Athena, quite a good question you have asked for. So this is what I always say when we take a session, a lot of learning comes from the audience also. So this is definitely a point to be looked at. Companies which are making losses or only on the burnout phase, that means expense phase, should be registered, should be looking for registration with corporate tax so that they can claim the losses in the future period when the profit comes into. Now, actions to be taken again from a digitization perspective, a lot of things are happening. So, which we talked about when you look at FTA, they are creating a complete digital framework of how VAT and customs are linked, how economic substance, how VAT and corporate tax and economic substance is going to be linked. So whenever we do any transaction, it's important to assess 360-degree impact of in-house and regulatory framework. So we should not be thinking that regulators are not talking to each other. Under the AML framework, under the tax regime framework, a lot of data is getting shared across the regulatory authorities. So we need to be very cognizant of the fact how these things will work into. So digitization will be a strong pillar for corporate tax implementation in UAE, along with regulatory coordination. It is important to assess that 360-degree impact of in-house and regulatory framework is worked into.